Where would be an ideal place to take a failure? Within a confirmed trend channel or off a key entry point? Solid question. This is more complicated than one of the normal questions, but I'll do my best to answer it. So you want to take failures in places where you expect failures to work. I'm just trolling for a second. What I mean though is that after a failed breakout and where you expect a reversal. So let's say you have a range day. Here, I'm just going to do this. Let's say you have a range day and the price is moving within this range. Well, after you have like one of these where you have a short-term trend, let's say that comes up to the top of the range and you get a close outside and then a move to a new high, and then it starts to come back in to the range, and then you get like a failed second entry long, that's where you take one because you're expecting price to reverse back down. So if it forms into like a little downtrend and you get a failure there, that's where you expect a failure, at a reversal area. So you take a failure there. Now if it's within a channel, even better. Another time is like, let's say you come down to the lows and you already have a close outside of your downtrend and a move to a new low. So downtrend is played out. Then you come up and you make a higher low and then another higher low. That's like a failed second entry short. That's a place that you want to take it. Now you want it to be on the right side of the EMA. So if you're taking a failed second entry short, you want it to be forming above the EMA. If you're taking a failed second entry long, you want it to be forming below the EMA. That's part of my criteria with the 21 EMA. The other time that you can take a failure is as a continuation pattern. We had one that almost formed today. It's not quite one, but I mentioned this earlier and I'll show you right here. So if I make an arrow right here, this is a failed second entry short. And so you have a new low here and you have a first entry short right here. And then you have a second entry short and it's a failure and a really bullish bar and you're in an uptrend. That's a continuation pattern. You wouldn't necessarily take this one exactly because it's not off of a key entry point or off of a trend channel or anything, and it's going straight into the highs. But if this formed like closer to the EMA and you had room to the highs, that would be a continuation pattern that you could take. So those are the two places, the two ways that you look for failures. In reversal areas after short-term trends have played out, or within a continuation pattern. But don't trade them if you're new because they are way complex, and a lot of times if you trade the failure, you're going to be the one that gets trapped. You asked what tick rate would I recommend for the MES? So this one changes quite a bit, right? Like, so when the MES first came out, when I started trading, it was just the ES. And the MES didn't come out until 2019, but I started trading in 2017. And at the time when the MES first came out, it was something like 900 ticks. If you set your chart to 900 ticks, it was about the same as a 2000 tick ES chart. Then it kind of went to like maybe 950, then maybe 1000. And then it started to go up, and then it was like 1200 ticks. And then it kind of kept going up. And now it seems to fluctuate a little bit, but from what I've seen last time I looked, it was something like 1800 ticks maybe was close to a 2000 tick ES chart. But honestly, what I think is the best way to go is, and I teach this in my paid course, is to chart the 2000 tick ES chart, but have the MES invisible on there, and then you can execute MES trades on the 2000 tick ES chart. So that's what a lot of people do. How do I know when to sit on my hands and step away from the charts for the day? Well, for me, it's basically just a matter of a few things. Like right now, the ATR is below a 2. If the ATR is below a 2, it means the volatility is so low that it's going to be hard to find good trade setups. Now we're getting some bigger bars now, so we might actually form some sort of a down move here, possibly. We might. So we could start to draw a downtrend. What I would say is that I look at what the volatility is. That's a big part of it. If the volatility is too low for my trading style, then I'll probably just step away. If the volume is moving really slowly, I just know by looking at tick charts how much movement is happening. But the other thing is I also know what time of the day I like to trade. And so I don't trade beyond certain time frames. Like I keep my time of the day pretty specific, and I treat it like a job where I have like a shift and that's it. And if I get my trades within that shift, that's it. If I don't stick around and keep trading. You asked, is over trading worse than missing trades? I think that I would say probably yes. Because if you're just missing trades, you're not actually losing money necessarily when you're missing trades. You're not making money, but you're not losing money. if you're over trading, you're probably losing money. So I would say that's the big thing. Like, you want to be careful with what you're doing. When over trading can just completely obliterate an account, because a lot of times what happens with over trading is that you end up going into this mindset of like, then you start revenge trading, then you start forcing bad setups, and then you start to increase the amount of tilt that you're getting, which can be really detrimental. Now, skipping good trades can make you tilted as well, but you need to be really careful with all this stuff, and that's just a really important thing. So I wanted to make sure I talked about that a little bit. Do I think watching 10 mentors at once is hurting new traders? Yeah, I think when you have shiny object syndrome, which is really common in trading, you have a hard time learning. Because what happens when you're first learning how to trade is that there's all these different people telling you different things. There's different strategies out there with different risk-reward ratios, different scalping versus swing trading, what assets you're going to trade, whether it's futures, options, stocks. There's so many things that you can look at. And then within all those, there's different strategies, indicators, price action. There's a lot of garbage out there. There's a lot of bad information out there. There's a lot of people out there who are just making trading content who aren't even really trading. And there's a lot of weird stuff that goes on. And I'm not, no shade at some of these other people, but the point is, when you're a new trader, it's overwhelming. When I was first learning how to trade, I went through this trap. I was buying trading books. I was watching different YouTubers. I was trying out some different courses. I was doing all this stuff and just wasted so much time, money, energy. And that's why it goes back to what we talked about earlier, which is, if I could go back and do it all over again, all I would do is trade the way I trade right now. I would trade the 2000 tick ES chart using simple price action, and I would not diverge at all. And I would be a scalper the way that I am now. I wouldn't mess with anything else. I wouldn't even learn it. I wouldn't even learn what indicators do besides the 21 EMA, which is the one that I use. I wouldn't even learn about, the MACD and the wave trend and all these other things that I've experimented with over time. I wouldn't even mess with any of them. I wouldn't mess with learning about the volume profile and all these things that I've used in the past, like order flow, footprint charts, you name it. I've tried it. I wouldn't do any of it. I would just do this. And by isolating down to just doing this one thing and mastering it, you don't ever need to do anything else, because you find trade setups every day that make you your living, and a really, really lucrative one that provides a ton of freedom. So there's no point of learning the other stuff, because then you have to unlearn bad habits. And that was my biggest problem. When I did commit to learning this style, I would leave sometimes doing it because I was used to other styles of trading. So I'd have a string of losses, let's say, and then I'd be like, you know what? Maybe I need to go back to this other style that I used to do. And I'd flip-flop around, and that just slowed me down from my progress. Whereas if I just stuck with this the whole time, it would have just been amazing. So I think trying to learn from, learning from 10 different people is not going to work. You want to commit to learning somebody's style that you trust, that you've looked into, and go with that. Now for me, that was Mac from Patch Trading. So I learned from Mac, and that's who I mostly committed to. And I tried, like I said, I tried some other traders. I even tried some other price action traders. I just didn't resonate with them. But Mac's style is what I really committed to doing, and that's how I learned. And so I think now for most people, if you're learning from 2 people or 3 people that trade the same way, that's probably fine as well, because as long as the style is basically the same, then you're good to go. I think you can learn from you can have 1, 2, maybe 3 people that you're learning from. I think if you start to get more than that, it's going to be too much, and there's going to be conflicting stuff going on. So you really want to commit.